We are diving deep into one of the biggest names in athletic apparel today,
Yeah.
a brand whose Q3 results show this fascinating duality.
Right.
You've got monumental success internationally, but it's masking some very real struggles right here at home.
It really is. It's like two different companies operating under one roof.
And all of this is happening against a backdrop of a sudden leadership change and, well, new trade policies that are set to cost hundreds of millions of dollars.
Yeah. And for this analysis, we went right into the raw financials you shared.
Yeah.
We're talking about Lululemon's Q3 fiscal 2025 10Q filing, the official earnings release, and their supplemental investor graphics.
So this covers the 13 weeks ending on November 2nd, 2025.
It does. And it paints this really complex picture of a company that's just succeeding wildly abroad while fighting a genuine battle, you could say, in the Americas.
So our mission for you is to connect these dots. We're going to unpack what drove that overall revenue beat, why the margins shrank so much despite that growth, and what this unexpected CEO change means for their big Power of 3x2 strategy heading into 2026.
Okay, so let's start with the hard numbers for Q3, the headlines.
What hit the wire?
Well, on the surface, the numbers look pretty solid. Total net revenue hit $2.6 billion.
That's a 7% increase year over year, which sounds good.
That's a massive figure, and it did exceed expectations.
And the bottom line, the earnings per share also surprised the market, but there's a big asterisk there, right?
Absolutely. So diluted EPS, our earnings per share, came in at $2.59. And we have to note two things here. First, diluted just means we're accounting for all potential stock shares, which is, the most realistic measure.
The conservative number.
Exactly. And second, while that 259 beat forecasts is actually down 10% from the 287 they posted in Q3 of 2024.
So they beat expectations, but they didn't beat their own past performance.
That's the critical distinction.
Okay, so let's unpack this 7% revenue growth. I mean, 7% sounds healthy, but the core metric everyone watches, comparable sales, is telling a much, much slower story.
This is the crucial technical point you have to understand. Total comparable sales. They increased only 1% overall.
1%.
1%, or well, 2% if you adjust for currency, which we call constant dollar basis. It's barely moving the needle.
So the bulk of that impressive 7% revenue growth must have come from new stores, not from better performance in their existing ones. Is that what the sources show?
That's exactly it. That low single-digit comp sales growth tells you the driver wasn't, more customers in their established stores. It was pure physical expansion.
How many new stores?
They opened 12 net new company-operated stores just in the quarter. That pushes their total footprint up to 796.
So the foundation isn't growing quickly, but the building itself is getting bigger.
A perfect way to put it. They're adding more rooms, but the existing rooms aren't getting that much more traffic.
Okay, let's talk profitability. This 7% growth clearly came at a cost because the margins took a substantial hit. Gross margin decreased 290 basis points.
2.9 percentage points.
Landing at 55.6%, that's a lot of pure profit just vanishing.
It's a significant squeeze, yeah. And the 10Q filing gives a really fascinating breakdown of the pain points. The main culprit was a 300 basis point net decrease in product margin.
And this wasn't just one thing, was it? It was a few challenges converging.
Exactly. That's where the risk lies. There were three.
Okay, help us break that down. What were the three big drivers?
First, they cited higher tariffs. That immediately jacks up the cost of goods before a product even hits the shelf.
Right.
Second, increased markdowns. And third, they saw higher costs from their credit card affiliate programs.
Okay, so let's put that together for you. They're paying more to import the clothes because of tariffs. They're spending more on incentives, those affiliate programs, just to get you to the website.
Right, to drive traffic.
And then once you're there, they're often having to discount the product with a markdown to actually make the sale.
Precisely. They're getting hit from three directions at once. Now, they did note that higher prices helped offset some of this, but clearly not enough.
So how did this flow down to the operating line?
Well, if we connect this margin squeeze to the bigger picture, income from operations, that's the core measure of profitability, it decreased 11%, down to $435.9 million.
Which means the operating margin itself
Shrank by 350 basis points, so 3.5 percentage points. It's down to 17%.
That reduction is the true cost of doing business in this environment. And speaking of competition, if they're using markdowns and affiliates to drive sales, That has to connect back to a core risk we saw in the sources.
It really does. The source material is very clear that Lululemon's core fabrics, their manufacturing tech,
Mm-hmm.
the very things that give them that premium feel, they're often unpatented. So if a competitor can imitate a successful product pretty easily, then Lululemon's only real defense against discounting is just constant, rapid, high-quality innovation.
And this markdown pressure suggests that the competition is already successfully crowding the market.
I think so, which makes this next segment even more vital. We're getting into what you call the tale of two markets.
The regional performance is, I think, the most critical takeaway for you. It shows where the company is thriving and where it's facing a structural crisis.
The gap between their core established market and their growth engines is staggering. It's like two different businesses.
Let's start with the headache then, the headwind, the Americas. Net revenue here actually decreased 2%.
But the truly worrying number is that comparable sales figure. America's comparable sales decreased a substantial 5%.
5%. That is not just a slowdown. What did management say was causing this decline?
That 5% drop reflects a few key struggles in the U.S. and Canada. They specifically cited lower average order value, lower conversion rates, and critically reduced store traffic.
People just aren't going to the stores as much.
Right, and they're attributing it to general economic uncertainty. People are not just buying less, they're visiting less often, and they're spending less when they do visit.
So the consumer is tightening their belt on discretionary stuff, and that's hitting the physical stores hard. Did digital sales pick up any of that slack?
It helped a little bit. They noted the decrease was partially offset by higher e-commerce traffic, but that was itself partially driven by those credit card affiliate programs we mentioned.
So they had to pay to get those online customers.
It seems so. The consumer wasn't avoiding the brand, but they clearly needed an invitation or a deal to shop online.
Now let's pivot to the engine. The part of the business keeping the whole ship afloat, international.
I mean, here the growth is just breathtaking. International net revenue absolutely soared. It increased 33% year over year. And international comparable sales were up 18%. That kind of momentum just completely dwarfs the domestic problems.
And the undisputed star player in that story is China mainland. The numbers there are just immense.
They're astonishing. That market saw net revenue jump an incredible 46%, 47% on a constant dollar basis.
46%.
And China mainland comparable sales increased 24%.
And that was fueled by e-commerce, right? Singles Day.
Exactly. Strong e-commerce traffic. And they specifically pointed to the timing of Singles Day events.
That's a key detail. I mean, Singles Day is the largest online shopping day in the world. Being able to leverage that shows they really have deep market penetration.
And it wasn't just China. The rest of the world, APAC, EMA, they were strong too. Net revenue up 19% and comparable sales up 9%, mostly driven by increased traffic.
So international success is papering over a fundamental weakness at home. But how long can you rely on China's massive growth to cover a 5% comp sales decay in your core American customer base? Isn't that masking a huge risk?
It absolutely is. And CEO Calvin McDonald noted that the teams were focused on driving improvements in the U.S. business. But he really tempered expectations.
How so?
He said they continue to expect to see the impact of this work in 2026.
In 2026, not next quarter.
Exactly. That phrasing suggests this is a long-term fix, not a quick patch. They're essentially borrowing momentum from their international business to buy time to fix their domestic one.
Let's move on to the cost factors that are compounding these sales issues. I want to focus on the policy and regulatory headwinds because these have a very specific, quantifiable price tag.
And these external policy costs are massive and immediate. Let's start with the U.S. trade policy shift, the de minimis repeal.
Can you just explain the de minimis rules simply for us?
Sure. Historically, Lululemon benefited a lot from the U.S. de minimis duty-free exemption. It was basically a huge tax break they used for shipping low-cost online orders from their Canadian distribution centers into the U.S.
So no duties on those small packages.
Right. But an executive order, effective August 29, 2025, removed this exemption.
So they lost a quick, cost-effective, duty-free way to ship millions of individual e-commerce orders into their biggest market. That immediately inflates their fulfillment costs?
That's exactly it. And that's just part one.
What's part two?
Part two is the general tariff burden. The U.S. implemented a 10% baseline tariff on imports back in April 2025. This affects countries that supply most of their products.
So when you combine the new 10% tariff with losing that de minimis exemption,
You get a huge, non-negotiable cost increase.
okay, give us the big number. What's the total financial impact of this after any mitigating efforts they tried?
This is the headline figure you should remember. The company stated that these combined trade policy changes are estimated to reduce their income from operations, their operating profit, for the full fiscal year 2025 by approximately $210 million.
$210 million. Wow. That's an enormous external burden you have to overcome just to get back to where you started.
It is. And the documents clarify they're already feeling the pain. $60 million of that impact was already recorded in just the first 3 quarters of 2025.
So this is hitting their profitability right now. It's not some future problem.
Not at all. It makes managing margins incredibly difficult, even with that strong international revenue.
How are they even trying to mitigate a cost that big? I mean, you can't just absorb $210 million.
Well, they're fighting back on 2 main fronts. First, vendor negotiations. They're trying to get their manufacturing partners to drive down costs.
And second,
Selective price actions, which means they are quietly increasing the price on some items to offset these new burdens. But even with all that, the net hit is still $210 million.
so amidst this domestic slump and these huge external tariffs, the company did signal some confidence in its balance sheet with a big capital move.
They certainly did. The board authorized a huge $1 billion increase to their stock repurchase program.
So they're buying back their own stock.
Right. That brings the total they're authorized to buy back up to $1.6 billion. And they already bought back $189 million worth of stock in Q3.
That's a classic move. It signals management thinks the stock is undervalued and shows confidence in their long-term health, even with these immediate headwinds.
Exactly.
Okay, let's pivot to the operational and product performance in Q3. Which categories showed the most life? Is the innovation engine still running?
The innovation engine is definitely running, but maybe a bit unevenly. All the apparel categories did show growth. Accessories and other led the charge, growing 12%.
And what about men's and women's?
Men's apparel was up 8%, and women's was up 6%.
Yeah.
And the documents note specific strength in their key technical categories: outerwear, run, and train.
That's interesting. It suggests that the product where function and performance matter most is still succeeding, maybe where that imitation risk is a little lower.
That's a great point. Now, if you look at how those sales were made, digital revenue grew 13%, but store revenue was flat. 0% growth.
That flat physical store growth is incredibly telling. It just underscores the difficulty they're having driving traffic in the Americas, even with a strong pull from e-commerce internationally.
And this ties directly into the inventory story.
Right. If sales are slowing down in your biggest market, that product has to go somewhere.
Exactly. Inventories increased 11% year over year in dollar value. They hit $2 billion at the end of Q3.
$2 billion in inventory.
Now, they did clarify that it's only a 4% increase on a unit basis, but that dollar value climb reflects those higher costs we talked about, the tariffs, and the need to manage supply because of the softer demand in the U.S.
So they have warehouses full of higher cost inventory that needs to be moved, which is only going to increase that markdown pressure later on.
It's a tough cycle.
And all this volatility, soft demand, high costs, rising inventory makes the next piece of news announced just after the quarter even more impactful: the leadership transition.
Yeah, this came as a pretty big surprise on December 11th. The CEO, Calvin McDonald, and the board mutually agreed that he will step down, effective January 31st, 2026.
And this is happening at the absolute moment they need maximum stability to tackle the U.S. sales problem and that $210 million tariff headwind.
Right.
So what does the new leadership structure look like?
Well, it's a move designed to emphasize stability through dual expertise. Marty Morfitt, who is already chair of the board, was appointed executive chair immediately to oversee the transition.
Okay.
But most importantly, 2 long-term execs, Megan Frank, the CFO, and Andre Maestrini, the president and chief commercial officer, were appointed interim co-chief executive officers.
Co-CEOs. That's interesting.
It is. It's effective January 31st, 2026, while they search for a permanent leader.
That co-CEO structure suggests they don't want to choose just one skill set right now. They need Frank's financial discipline for the tariffs and margins, and they need Maestrini's commercial vision to drive that international growth and fix the Americas.
I think that dual mandate is absolutely necessary, given the complexity. And despite all of this, the company did update its full-year outlook.
What are they guiding for?
They're expecting net revenue of let's see, 10.96 to 11.04 billion. That's about 4% growth, or 5 to 6% if you exclude the extra week they had last year.
And earnings?
Diluted EPS is expected to be between 12.92 and 13.02, so they are guiding toward continued, though slower, success.
So what does this all mean for you? You now have the full picture. A highly successful international strategy, especially in Asia, that is strong enough to offset this crucial immediate weakness in the home market.
But that success is compounded by a major, quantifiable $210 million cost challenge from trade policy shifts.
And it's all happening during a complex dual leader transition in the executive office.
The challenge for the new interim leadership is just immense. If we go back to that core risk we identified, the fact that their premium fabrics and tech are often unpatented, making imitation easy, the stakes are raised exponentially.
Okay, give us the final provocative thought.
With a complex, dual-mandate transition in the C-suite and competitors that can imitate your hit products pretty quickly, how much risk does this organization face if the pace of high-quality, non-imitable product innovation slows down in 2026? Especially while they are simultaneously tackling a $210 million cost headwind and trying to rebuild connection with the U.S. consumer, who is currently voting with their wallet through a 5% comparable sales drop. I mean, the pressure on those R&D and product teams has never been higher.
That gap between innovation speed and operational costs is where the real drama is going to unfold. Thank you for joining us for this deep dive into Lululemon's Q3 balancing act. We encourage you to continue exploring the implications of those trade policy shifts and the interim leadership structure on the brand's future.